Devika Shivadekar, what do you do and why should we listen to you?
Hi, David. So I am an economist working for RSM Australia. I'm their inaugural economist, so been trying to setting up their coverage of macroeconomic indicators, looking at the Australian economy. What I essentially follow and track is the growth patterns, GDP, inflation, labor market, RBA interest rate decisions, what's happening globally and how that shapes business strategies in Australia, particularly the SME sector. Why you should listen to me is probably because I'm quite a fun person, despite being an economist. So I try to intersperse some data with some fun anecdotes that people find relatable.
Yeah.
I think that's the most enjoyable part of being an economist is if you are able to differentiate between simply talking numbers with talking the actual story behind those numbers, it makes a world of difference to the people listening to you. And that is what I try to do.
Yeah.
And it's been well received so far.
We're going to ask you a few questions that we want you to break down and explain to us like we were 8 years old.
Absolutely.
All right, so my very first question, inflation, interest rate hike, fuel price surge. What the fuck is going on?
So, well, look, David, it's all very uncertain, right? Let's go step by step. Let's look at inflation first. Then we speak about interest rates and why interest rates are important when we talk about inflation. And then we move on to the external shocks, which we are experiencing right now, which is the fuel shock.
Yeah.
Inflation, what is inflation? Inflation is the rate of change in prices, not prices. So essentially, by nature, prices are always going to go up. Very rarely it happens, unless you are in a recessionary environment, that prices go backwards. So when they're moving ahead, it's very important that the speed at which they're changing, that remains contained. That is what is inflation, the speed at which prices are moving up. The RBA targets to keep that price change in the 2% to 3% margin, which is why they try to increase interest rates to curb demand. Now, Economics 101 is if demand outpaces supply, which means you're demanding more goods and services, but your economy is not producing those goods and services to match that level of demand.
Yeah.
There's a mismatch. People want more, but we are not able to provide that level. Economics 101 says demand higher than supply, we have the problem of inflation.
Yeah.
So prices start going up much faster than where the central bank would like to see it. So when they increase interest rates, essentially what they're targeting is they're targeting that demand. What they try to do is when they increase interest rates, the repayments go more towards mortgages than towards discretionary spending.
Yeah.
When that happens, automatically cash splurge elsewhere starts going down. So by nature, your demand starts falling, and they try to find that balance between supply and demand to bring it at a parity level.
Yeah.
That is how they try to control prices. It's very important to also acknowledge that interest rates are only a very, very blunt tool. The only thing it controls is demand. There's nothing else it can control. So obviously it hurts the mortgage holders the most in comparison to everyone else because, of course, interest rates go up, banks start charging higher interest rates, mortgage rates go up. So essentially there's a small cohort of the Australian population which gets hit the hardest, but it's just that one particular lever that a central bank has. It really cannot do much. That brings us to the question of fuel shocks. Now, this is very interesting. The RBA can control what it does domestically. But if any kind of price shock comes from outside of Australia because of geopolitical tensions in the rest of the world, it is completely beyond their control. What we are experiencing today, the fuel shock because of the unrest in the Middle Eastern region, is essentially a supply shock, an external shock, which the RBA cannot do much. However, it's very important for the RBA from the perspective of inflation because when fuel goes up, transportation costs go up for essential goods such as food, groceries, medical services, construction businesses, all located inside Australia. And essentially what those businesses might start doing is they start passing on those costs to consumers. When that happens, we are again back to the problem of inflation. So while the RBA cannot control those fuel shocks, the RBA can increase interest rates to make sure that demand for other goods and services inside Australia remains contained. And that's how they try to just manage the external shocks with the domestic price movements and try to bring some sort of a balance.
So in saying that, do you see them easing the interest rate anytime soon then?
No, I don't.
Why?
It's a very tall order because look, even if we remove the fuel shocks, if we look at core inflation, which is entirely domestically driven, let me describe core inflation first.
Yeah.
Core inflation, so our overall inflation basket has 82 subcomponents, 82 to 85 subcomponents. Mm-hmm. Essentially, core inflation, what it does is it strips out the top 15% and the bottom 15%, removes them, and only focuses on the middle 70% of that basket. Mm-hmm. What those 70% categories are the ones which are not impacted by any kind of external shocks, are not impacted by any kind of subsidies that the government might offer. For example, electricity. Electricity prices move up and down if the government comes out with energy rebates. Mm. Housing, of course, is one of the core categories because housing inflation is something that government could potentially control, but not so much. So core inflation essentially are those categories which do not move by these external factors, neither by government intervention nor by any external geopolitical shocks. So when the RBA looks at core inflation, of late we have seen that even if we remove these fuel shocks, domestically driven core inflation in Australia has been trending very high. Headline inflation, as per the data released yesterday, was sitting at 3.7%, which is the entire CPI basket. Yeah. And core inflation is sitting at 3.3%. Both those classifications of inflation are actually higher than the RBA's desired target range of 2% to 3%.
Yeah.
So core inflation, you remove fuel shocks, we already have a problem of inflation. So regardless of what happens externally, the RBA is going to be focused on what is happening to domestic price pressures. Of course, on the flip side, when we are talking about easing, should the fuel shock bring about such an intense price pressure domestically that we start moving backwards. Businesses start closing down. Businesses start laying people off. People stop consuming, which means essentially people stop going out and spending money. So businesses essentially go on the back foot because they're not getting demand for good services. They're not able to generate revenue. So economic activity starts going backwards. It means we are moving in the recessionary territory. Yeah. Should that happen, should these external fuel shocks become a drag on growth, global as well as domestic, that's the only time we can actually consider the RBA think about easing interest rates.
How long does it need to stay like this for us to go into recession?
Interesting. Look, there are a lot of moving parts, so it's very hard to quantify. For example, it could unravel in a matter of a month.
A month,
because things could go awry, horribly awry. However, it's so hard to quantify how long it's going to last because we can't predict it. There's dialogues happening. We just saw last week that, not even last week, just 2 days ago, that President Donald Trump came out and said he's going to bomb Iran's most critical gas facilities. Yep. And Iran came out and said if it does that, it's going to destroy Israel's facilities. It's going to keep bombing the Middle Eastern region, the U.S. military bases. So it's a power play, right? We can't control what's happening there. We can't control who's going to do what. So things could go horribly wrong in a matter of months, or the talks could potentially stall everything and we could be sitting at a status quo, nothing happening for a good 6 months with simple dialogues happening and that moving the market up and down. So it's very hard to quantify how we are going to perform in the near future. I mean, if I'm being completely honest, I don't have a crystal ball. So it's incredibly difficult to say when we are potentially going to either go into a recession or not go into a recession and come out of it.
Yeah, but looking at the trajectory at the moment, with things are going what do you believe is the industry that's going to get hit the most and first? I assume supply chain.
Supply chain 100%, but before supply chain comes the issue of agribusiness.
Agribusiness?
Absolutely. Agribusiness is going to be hit the hardest because they depend entirely on fuel.
Yep.
They depend greatly on harvesting. They depend greatly on fuel for their seed programming. And I believe in Western Australia, the current season is the season when they sow seeds. So it goes on for around 6 to 8 weeks when all the farmers in Western Australia are actually planting their crops. They cannot do that judiciously or efficiently without heavy machinery. And for heavy machinery, they need fuel. So with fuel prices going up, understandably, the people who haven't been able to stockpile or they haven't been able to fill their machinery with fuel, or they are facing the issue of extremely high prices, we are going to see their produce being much lower in comparison to their previous years. So when the yield is going to be lower, obviously their supply to the market is going to be lower. On top of that, when it comes to supply chain, transportation costs are also going to go higher. So we already have lesser produce, higher transportation costs. So essentially what we're going to get in the markets are much pricier fruits, vegetables, or anything that is produced agriculturally in Australia.
Because the level of demand is still the same.
Absolutely.
And it's not going to ease inflation anytime soon.
Absolutely. And unfortunately, believe it or not, people are panicking now. And we know what happened the last time people panicked during the pandemic, stockpiling. So that is what happens. You already have your supply shortened because of all these factors such as fuel prices, transportation, not being able to keep up with the produce levels. And you've got people who have access to those markets stockpiling without thinking about extending the longevity or thinking about the society at large. That just take what you need today so we can have more for everyone tomorrow.
Yeah.
That's unfortunately not the kind of approach we are seeing. We are, in fact, so many instances that we are seeing people fill up jerry cans in suburban driveways. You don't need so much fuel. Just fill up your car. And if you do go to work, you could just take public transport where available.
Yeah.
You are not front of the line. Front of the line are the farmers who need fuel to produce crops, so we get to eat food. Front of the line are healthcare workers, essential workers, construction workers who are critical for the optimal working of our economy. Yeah. A person working a white-collar job in an office is not a priority.
So how long do you reckon it'll take until government will start rationing?
Well, it's interesting, right? I firmly believe that the government should actually come out first and communicate very clearly what responsibility we as Australians actually have. And that starts by classifying who are the people who actually need to be prioritized in these trying times. A good way to do that, I would say, is the first step would be to give daily or weekly updates on where fuel is at different in different parts of Australia. Simply saying that national fuel reserves are secure, we are going to be giving out 100 million barrels of oil because we have now moved to diluted forms of petrol, diluted forms of fuel, just to increase the supply is not enough, because there already are pockets of regional Australia where the petrol pumps have completely dried out. It doesn't help for the government to actually come out and say that on a national level we are fine. There has to be some form of targeted communication so people understand what are the areas that are hit the hardest, what are the areas that they could potentially divert to in order to fill their fuel tanks for their business needs, so we are able to properly ration it. That is the first step. Should that fail is when the government should actually come in and go a bit harder and start prioritizing and classifying the categories of people who need access to fuel first and foremost, and who shouldn't be one of the priority ones.
So do you see this event, could it trigger the mortgage stress or 2008 GFC?
2008 GFC is a bit too strong, I would say, in my opinion. However, mortgage stress is something that's already been experienced. I mean, we don't even need to wait. The RBA has already hiked twice in this year.
Yeah.
It's just the beginning of 2026. We've already seen 2 hikes. There's expectations that there's going to be more should inflation not come down. So mortgage holders are going to be under a lot of stress this year. Of course, that is going to translate to house prices moving, I wouldn't say moving down, but moving slower. In the sense that there have been pockets of Sydney, for example, which were registering double-digit growths up until late last year. But now they are registering just single-digit growths. So it's still growing, but it's growing at a much slower pace.
Why don't you think it could go down or even in a negative growth?
It could go down. It could go down, but at the moment it'll go step by step, right? Double-digit growth becomes single-digit growth. Single-digit growth becomes flatlined price growth in house prices. After that, it goes negative. So it's a cycle. There's a very good chance that it may not happen because some of the investors who are holding investment properties might just decide to sell them off because it's harder to hold on to properties when your mortgage rates are going up. So you have your principal property of residence. You decide this is the best time to sell your investment property because the mortgage is getting much higher, which means organically, the supply just goes up just a little bit. So that kind of buys time to the housing market to perhaps not go entirely into the negative territory.
I wanted to touch on that though. So when you say that investors are deciding to sell their properties, there is a supply and demand factor here as well. If there is not enough demand or there is not enough people, there are not enough people in Australia that could afford to purchase the property, what would happen to the prices then?
We have been living that, right? We have been living where first home buyers have essentially been priced out. It's always the investors who jump into the property market, who outbid the first home buyers, and who are able to capture the market much more effectively than any potential new home owner.
So you believe there is still enough investors pool that are able to purchase these properties?
Absolutely, they are. Because leading up to today, leading up to this crisis where RBA is now forced to hike interest rates, equity asset prices have actually been increasing because demand doesn't fall and supply is lagging. So investors essentially have been sitting on some solid equity going into this year. But beginning of this year, with the 2 interest rate hikes, now suddenly mortgages are more expensive. Suddenly we are hearing with the federal budget around the corner, there's growing demand for slashing capital gains taxes on more than 2 investment properties. So a lot is happening in order to ensure that supply does increase. People who hold multiple properties are able to release them into the market. So the people who actually want to enter and buy their principal property of residence are able to purchase those. So there's a lot happening behind the scenes, which will determine how prices move in the housing market. But the first and the hardest blow, of course, is to the mortgage holders from the interest rate increases.
So what about businesses? Businesses that are, well, if you're predicting a hard time going ahead, should businesses take out business loans to support the cash flow for a temporary, let's call it temporary, for a temporary dip in the supply chain or in their sales?
Look, taking business loan ultimately is a highly subjective matter. For example, it really differs between large businesses who are able to divert or maybe reduce the scope of their business. So if they've got many verticals, they just stop a couple of them, divert all their attention and funds towards one particular core focus area, which seems to be working well. But there's also small businesses, particularly in the regional areas, simply because of the economies of scale, they aren't able to survive this environment. When we were just coming out of the pandemic, already those small businesses were quite hard-strapped.
Yep.
And all of them actually had to, so many of the businesses we heard from our clients they were having to sell their personal assets to keep the businesses afloat. Because RBA was also on a hiking cycle to tame inflation, and demand was actually quite low because everyone was quite concerned. Everyone was saving their money. People weren't spending much. So we have been through this cycle. So businesses, in my honest opinion, are actually much smarter this time. They have lived through this experience once, and they are better prepared. They're asking better questions. So when it comes to taking business loans, it's ultimately whether you see yourself being able to stay afloat for, say, 6 months, which is what is near to medium term, where you could expect all these global tensions to relax a little bit, some semblance of sanity to come into the general economy. So 6 months, does it buy you 6 months' time? Yes, it does. Do you think you'll be able to repay those loans and not go under administration should consumer demand not pick up? I think I could do that. Sure, go ahead for a loan. But if you think your consumers are not going to come to you in these tough times with higher interest rates, with the inflation problem, then I would advise against going for a business loan, simply because it's going to be quite tough to service your debt obligation.
So, in your opinion, what industry or what sort of businesses that you see could be a winner in this situation right at the moment?
Very interesting. Give me a moment. I'm going to have to think about
Take your
this.
time.
Who could be a winner? Of course, banks.
The banks.
The banks. The banks are going to be the winners, right? You are in a high interest rate environment. Of course, the number of people who are going to reach out to you for more mortgages, for topping up their more existing mortgages or for newer mortgages, that number might fall short. But there's still no dearth of people who are going to still reach out, whether homeowners or business owners, who are going to be going towards lenders and try to get the most competitive rate to get a good deal for their loan. So number one is banks. Number two, agribusiness is suffering. Construction is suffering. Honestly, nobody.
So the banks.
Just the banks.
The gold holders.
The gold holders.
There are debates online that are saying that the inflation is actually caused by government spending, not consumer spending. But from what we've spoken about just now, you imply that the inflation is caused by consumers. Which is the correct one?
Look, it's a very valid debate. And we've moved on from government spending to consumer spending. So these parts of the economy keep changing all the time. They keep changing hands. Now, everything usually makes sense in hindsight. When you are in the thick of the in the thick of the moment, the government did what it thought was best. For example, if we go back to the pandemic era, by spending higher on public infrastructure, by keeping public spending higher, it ensured that the economy keeps moving, the economy keeps growing, albeit at a much slower pace, because consumers weren't in a position to do that. Come last year, we saw since the second half of last year that government spending actually reduced, interest rates started going down, and consumer spending started picking up. So they've both changed hands. Back then, during the thick of the pandemic, it was the government who had to do what they had to do. Today, the consumers, the consumers felt comfortable enough to start spending more. We saw discretionary spending go up. We saw sales during particular holiday periods, EO5 sales, Black Friday, Cyber Monday, all of them go up. So it keeps changing, right? And things always make sense in hindsight. Today, we can argue that government spending was what resulted in higher inflationary problem. But back then, it was important to keep the economy moving. Where I do see an issue is government spending, unfortunately, was high when the RBA was trying to increase interest rates to reduce inflation. So net, fiscal policy and monetary policy, unfortunately, were working against each other. That is the only issue I see with government spending, where it didn't work along with monetary policy. It unfortunately worked, I wouldn't say deliberately, but it inadvertently ended up negating the impact of interest rate hikes in the previous hiking cycle of the RBA. So this time around, the government has a bigger responsibility with the May budget just round the corner to be very conservative in its spending, to give a much more mature, neutral, and in fact contractionary budget, which is going to support the RBA's aim of taming inflation.
You hinted before as well that the government might be able to control the housing prices. How do you believe the government could control the housing prices?
a couple of things that we did discuss previously was, reducing the capital gains taxes that
Yes.
the government is considering, which is a good way to do that because it organically increases supply in the market. People who've been hoarding properties, who've been holding some massive property portfolios, they are going to release their assets. That is one way to do that, to control. The second way, obviously, is something that the government is trying to do, which is to increase the supply of housing, to build newer housing. But over here, the biggest challenge they face is that the only way to match those numbers is to go into higher density housing. Now, they are faced with increased red tape. So one good way for the government to improve that process is to reduce red tape so that construction companies can actually get into the market, get their job done quicker. Number two would be to improve standards of building so that the businesses who are in the construction industry are held at a higher standard. So the houses that are built, whether high density or lower density, are in fact of good quality. And third and most importantly, I think the government also needs to understand that construction costs are continuously going up. We are facing labor shortages in the construction industry. We are facing raw material shortages as well because Australia depends a lot on importing goods for the construction sector. So with increased freight costs because of these geopolitical issues, understandably, costs for building a house go up. Now, in such an inflationary environment, when the government comes out with policies such as 5% deposit, what it does is floods the market with more buyers.
Yeah.
But supply is still lagging. So they need to come up with policies which are going to increase supply before they increase demand. Of course, they are coming from a good place where they want first home buyers to have their own property, to purchase their own house. And the 5% deposit scheme is aimed to bring more people into the market. But without that supply, that's a moot exercise.
Do you believe the 5% deposit policy is a good policy to get buyers into the market?
At the moment, no, because like I said, it's creating that demand-supply imbalance. And with interest rates going up, I think the first home buyers who have barely been able to put together a 5% deposit are essentially going to end up with much higher mortgages than they would be able to service.
Yes.
And in an environment when we are expecting the RBA to go even higher with interest rates. So their repayments are going to be higher for an already stretched mortgage that they have taken up, which means they are going to be really cash strapped in the months ahead.
So realistically,
Yeah.
how can the younger generation get into the property market then, if that's the case?
Well, that's really tough, right? I mean, it's going to take a good number of years, or perhaps the younger generation who has been able to save, maybe stay with the parents, keep saving money, putting aside as much money as possible for their deposits, and then entering the market is one good way. But the most important factor I feel for the younger generation, or not just the younger generation, but Australians in general, I feel is we need that change in psyche where higher density housing is not seen negatively. It's perfectly fine to own an apartment. It's perfectly fine
Yes.
to own a townhouse. You have your own roof over your head. Maybe eventually you'll get a backyard. Maybe eventually you'll get a bigger house. But it's very important to understand that the end goal, sure, work towards a house with a backyard, but start slow. There's absolutely no shame in doing that. We have to give housing to as many people as possible. And the fastest way to do that is by higher density housing. So once the Australian psyche changes towards higher density housing versus having independent houses, is when we'll actually start seeing material change. And perhaps the government initiatives won't be seen as being detrimental to the overall cause of the housing market.
So doing what I do, I see two sides of the world. I see first home buyers as well that are coming into the market with 5% deposit. Now, this is what I wanted to discuss. With a lot of first home buyers that are coming to the market with 5% deposit, a lot of them got the deposit either from mum and dad or they've got wealthy mum and dad that are just advising them to, look, take advantage of these 5% deposit, first home buyer grants, etc. Just rake in as much money as possible. So these are the kind of people who don't actually need the government support that are purchasing the properties. On the other hand, because the younger generation have given up on purchasing their first home and claiming the eligible government grants, what they do is they purchase investment properties, which again in turn becoming an investor. So it broadens up the investor pool.
Yeah.
If that keeps going, how are we going to fix the housing market ever?
Yeah, so that's an excellent point that you've raised, David. Look, unfortunately, we are aware that there's a certain section in the society which has more access to housing compared to the other sections. So there's a clear divide. What you rightly said, people who have access to bank of mom and dad are less dependent on government subsidies, which means the responsibility then lies on the government to give targeted relief and not blanket relief. A good example would be the energy rebates that we saw previously over the last couple of years that were announced in the budgets, where everyone got energy rebates regardless of your income profile. Whereas, let's be honest, we are in such a position. We are lucky that we are not dependent on those energy rebates to service our electricity payments. But there's a certain section in the society who actually needs that targeted help. So the government's job is to do the right amount of homework to cap the 5% deposit at certain amounts of the property prices or at certain income level groups, and put in conditions such as if someone is able to access bank of mom and dad, or they are in a position where they do not need to depend on the government's 5% deposit scheme, they should be excluded from that. There has to be a rigorous vetting process, which means that initiative gets directed to the people who actually need it in order to get their first principal property of residence. The second cohort that you said, who are entering as investors, it's the easier way for them to do it. So essentially what they are doing is they are playing the long game. They may not necessarily be adding on to the investor pool, because investor pool, in my opinion, the ones who are skewing the market are the ones who have their own principal property of residence, who own multiple investment properties, some big, some small, which means people who actually want to own a home are not able to own a home and they're forced to rent it out. That is a problem pool. But the young generation who decides to perhaps rent west, as we have heard a lot going around in the market, they purchase investment properties and they rent elsewhere. They wait for the prices of the investment property to go up. They take equity or they sell that property, and then they go and purchase their own property. So that's one strategy that they are applying in order to be able to afford their own place of residence. So what the cohort with the bank of mom and dad are doing is essentially they are borrowing money from their rich parents. This group is just doing it on their own. They are availing the government benefit. They are purchasing smaller investment properties within their means. They're waiting for those prices to appreciate and then eventually sell that asset off and then go into a more desired area or a more desired type of house. So it's just different strategies at play here, is all I'll say.
How's the mortgage default rate or delinquency rate at the moment?
You'll be surprised. We're actually doing fairly well.
Yes.
And that's the reason the RBA considers that, what they really don't see that stress.
Yes.
Which is why they feel they've got more scope to go higher. Because while they don't want to completely demoralize the mortgage holders, Australians have been really smart with the way they've been managing their debt. They have, in fact, been ahead of their repayments rather than being in arrears. So again, there's a clear divide between the people who are ahead of their payments versus the people who are behind. A lot of the savings from the pandemic era still continues to sustain a lot of the households. During the RBA's previous hiking cycle, people were very judicious in the way they were spending their money. So the savings rate obviously was much higher on an average compared to what we have seen pre-pandemic. So people continue to hold jobs. Labor market is quite critical here. Australians continue to hold jobs, which means Australians continue to earn a steady income. When income is steady, understandably, you are in a much, much comfortable financial condition. You are able to service your debts. You are being smart in the way you are managing your mortgages. Electricity rebates is another example. If you are a full-time working employee earning a solid wage, the electricity rebate is essentially free cash for you. Most of the Australians have used all of these government subsidies to direct that cash surplus to their offset accounts or towards increasing their mortgage payments, the voluntary mortgage payments, which means they are running 3 to 4 payments ahead of the schedule.
Yeah.
So they are in a very comfortable position. So that's the thing, right? So many moving parts in the economy, yet we are doing very well when it comes to mortgage stress. But that could potentially change if the crisis that we are facing today continues for a long time and RBA is forced to hike even more in the coming year, more than once, maybe 2 or 3 times.
What's a long time?
I would say 12 months.
Do you see that happening?
Too soon to say. Like I said, what happens outside of Australia is highly unpredictable. Things could just fix themselves and everything is back to normal. So we are only focused on domestic inflation, which again comes back down to target levels with the RBA's moves, or we are facing at an extended period of unrest geopolitically, which means we are susceptible to external risks. We are susceptible to what's happening in the rest of the world. And that means there's really not much policymakers, whether RBA or the government, can do to really bring us out of that.
All right, let's prepare for the worst then. So what do you think, or what do you believe everyday workers could do to build their safety net or buffer?
I think the best one would be to be extremely conservative. Whether you are going to the banks to get a loan, whether you are deciding to spend, live under your means is what my suggestion would be for the next 6 to 9 months till everything normalizes. And that's the best way you can actually safeguard yourself from the worst possible conditions. Because when you start living under your means, leading up to a potential catastrophic event, you have sufficient buffer to take you over the line. But if you are maxing out your borrowing capabilities, if you are maxing out your spending, you are in a very precarious position. Simple example, you have a steady job today. You're not laid off. You have a solid income. Live below your means. Divert all of that excess savings that you have either towards your offset or to just simply hold on to that, because that's cash for a rainy day. But if you are someone who has a steady job, no matter what happens later, for example, if you are living under your means, you lose your job 3 months, 4 months down the line for whatever reason, it buys you 6 months' time to find another job. You're not completely under the debt stress. But if you're already maxing out all of your capabilities, you've borrowed at the highest possible rate, at the highest possible borrowing capacity that the bank allows you to, you are spending maximum, there's absolutely no saving. You are going to be in a lot of trouble should, unfortunately, you lose your job or be faced with some other condition.
The other condition being AI?
AI, absolutely.
So what's the trajectory of Australia's job market at the moment?
So again, just like the mortgage repayments, we are doing fairly well when it comes to the job market,
Really?
but that's unraveling. Now we are seeing a lot of these tech companies actually lay off significant amount of people. We are seeing a lot of banks lay off a lot of people with the advent of AI. So investment in AI is increasing, which means a lot of the jobs are actually either being diverted offshore or they have been completely scrapped. Now, that's another process that's very slow moving, but it has been happening. Now, with the labor market, a very interesting dynamic is at play. What we are seeing is that while full-time jobs, people are being laid off full-time jobs, part-time jobs are actually increasing. So people are still able to find multiple jobs to work part-time. Maybe they're doing 2 jobs, 3 jobs at a time rather than sitting at one place for whatever reason. Maybe they've been laid off, maybe there's not much opportunities, but people still are holding jobs, whether it's young ones, whether it's female participation. But we are sitting at 4.3% of unemployment rate, which is historically low. We are in a very, very tight labor market even now. Interestingly, though, the layoffs are happening because businesses, whether small, medium, or large, what they have started realizing is we have a big pool of people in the market wanting to get into the labor market, but not everyone holds the right skill set. So now businesses are being very smart about the kind of people they are hiring. This is an example I give most often. If we were thinking about, say, 2022, which was just post-pandemic, when businesses put out a job advert, they would probably get just 2 job applications. The business would hire both of them, would hire them competitive wages, because we didn't have enough people in Australia to fill that labor shortage. But today, what has happened is you put out 1 job advert, you get 10 applications, but none of them are good enough, because they do not have the right skill set. So we have moved from the problem of absolute unemployment to structural unemployment. It is not a problem of numbers anymore. It is a problem of skill set. So, which is why businesses have now realized that it's much better to invest in upskilling their existing staff. It is much better to invest in AI in order to counter these negative effects in the labor market where they aren't able to find the right skill set. And that's one way to actually tackle the problem of productivity. You invest in tech so that it becomes more efficient in its offering and the businesses continue to operate at optimal capacity.
So it's an employer's market at the moment.
Broadly, yeah.
Broadly. And do you believe that we're at a healthy productivity level?
No, I don't think so. Like I said, when skill set is an issue, obviously revenue generation becomes an issue, output generation becomes an issue. If you are essentially investing in an employee, but you're offering them higher wages, but they're not able to give as much output to your business, obviously your revenue margins are going to be squeezed. What that does essentially is when business revenue is squeezed, business investment is squeezed. When business investment is squeezed, economic activity starts going backwards. So productivity is at the core of it. You have to find employees who are able to work at their maximum operational capacity in order to generate revenue, in order to keep business investment moving, in order to keep the economic engine moving. We aren't at that optimal level, primarily because of the skill set shortages, and partly also because we need to become more self-reliant. We need to work smarter. Australia in general, I feel, when compared to the rest of the world, lags a little bit when it comes to innovation, technology, manufacturing, or just taking those risks that we see perhaps bigger economies like the United States taking. Having said that, I will say that being removed from the rest of the world, of course, means challenges are much higher for Australian businesses. Their pool is smaller, their scope is smaller, which means, understandably, they are more risk averse than the rest of the world. But you take the risk, you move ahead. If you don't, you lag behind.
So when it comes to innovations, like you mentioned before, there are two sides of the coins as well, because we do dabble in private equity and venture capitalists as well. And we see that a lot of the appetite of a lot of venture capitalists as well as private equity firms are in SaaS, whilst what I really believe that we should really focus on is agri-tech. So we see a lot of brilliant companies that are starting up that have brilliant innovation that are not getting the funding that they need. So they're not able to grow.
So that's actually a very good point, because that is what underlines what I said previously. We are not willing to take risks. We need to branch out. We need to be smarter. Rather than sticking to these established practices such as SaaS, which everyone knows, everyone understands, there is newer tech that is coming into the market. And that is where we need to be open-minded about. take that chance, take that risk, and see if that business performs or not. Things could horribly go wrong with an investment in SaaS also.
Yes.
But that doesn't stop these investors from investing in them. So it's a matter of taking that leap of faith. And once that attitude changes is when we will actually start seeing material changes, because I'm fully on board with you that there are businesses who are actually quite innovative in what they are coming up with to improve their operational capacity. And it is very important that they are identified and they are given the right levels of funding so that we can become more productive as a country.
So if you could leave one advice to the majority of Australia as a whole, as an economist, what would it be?
Number one would be conservative. Going forward for the next 12 months, live below your means is my top advice. And I think that would potentially solve a lot of problems. Secondly, it would be we need to feel that we are a society, we are a country, rather than simply looking at me, myself, and my family. And I say this from the point of view of stockpiling. We do not want to see the supermarket shelves empty. Everyone deserves to have access to food, access to milk, access to basic necessities, access to healthcare. Everyone deserves to have access to fuel, particularly, like I said, there are certain sections of the economy who definitely deserve to be front of the line. If you're simply filling up jerry cans in your suburban driveway, I'm sorry, please don't do that. So it's about living below your means and thinking about society at large rather than thinking just about yourself, because that's how, as a country, we can move ahead from these really uncertain economic times where it's honestly beyond our government's or the RBA's control. If we take collective responsibility to come out of it, it just makes the job of the policymakers a lot more easier.
Devika, thank you very much.
Thanks so much, David.